Stop right there. I need you to listen to me very carefully right now because what I'm about to share with you isn't just a financial tip. It's a fundamental shift in how you should be thinking about your health, your money, and your future. This isn't some minor loophole. This is a legitimate, government-sanctioned financial superpower that far too many people are either completely unaware of or, even worse, are using incorrectly and leaving literally thousands, if not tens of thousands or even hundreds of thousands of dollars on the table over their lifetime. I'm talking about the Health Savings Account, or HSA, and specifically its legendary triple tax advantage. And when I say triple, I mean it's not just a little bit better than other accounts, it is astronomically better, a true unicorn in the world of personal finance. So, let's dive deep, and I mean deep, into why this account is an absolute non-negotiable for almost everyone, regardless of your age, your health status, or your income bracket. First, let's get the basics out of the way, but I promise we won't stay basic for long. An HSA is a savings account that you can use to pay for qualified medical expenses. Sounds simple, right? Sounds like just another checking account or a flexible spending account, doesn't it? That's the first misconception I want to smash right now. It is not just another account. It is a chameleon, a shapeshifter, a financial Swiss Army knife that performs multiple functions better than almost any other vehicle out there. The critical barrier to entry, and one that often scares people away unnecessarily, is that you must be enrolled in a high-deductible health plan, or HDHP, to be eligible for an HSA. Now, I know what you might be thinking. High deductible? No thanks. I don't want to pay a ton out of pocket. And historically, you might have been right to be wary. HDHPs used to be seen as the cheap, bare-bones option for people who couldn't afford better insurance. But here's the reality check, my friend. Many employers are now only offering HDHPs, and even if they aren't, the landscape of healthcare has changed so much that for many, an HDHP paired with an HSA is not just a viable option, it's the superior option. An HDHP simply means your insurance won't kick in until you've paid a certain amount out of pocket. That's your deductible. But the trade-off, and this is where the magic begins, is that you get to open and contribute to an HSA. Without that HDHP, you cannot have an HSA. So if your employer offers one, strongly consider it. If you're self-employed, look into an HDHP on the marketplace. It's the key to unlocking this financial superpower. Now let's talk about the triple tax advantage. This is the core, the beating heart of the HSA's power. And I'm going to break down each triple point one by one and explain why each one is incredibly powerful on its own and why, when combined, they create something truly extraordinary. Advantage number one, tax-deductible contributions. This is the first layer of magic. Every dollar you contribute to your HSA is tax-deductible. What does that mean for you? It means that money goes into your account before it's subject to federal income tax and often state income tax as well. If your employer offers an HSA, they will typically allow you to contribute directly from your paycheck on a pre-tax basis. This is the absolute best way to do it because it not only reduces your taxable income, but it also reduces your FICA taxes, that's your Social Security and Medicare taxes. Think about that for a second. You are avoiding taxes on your income before it even hits your bank account. Imagine you contribute the maximum for an individual, which for 2024 is $4,150. If you're in the 22% federal tax bracket, you've just saved yourself $913 in federal income tax alone. Add state tax and FICA, and you could be looking at well over $1,000 in immediate tax savings just for saving your own money for your own health. Now, if your employer doesn't offer payroll deductions, or if you're self-employed, you can still contribute to an HSA directly and then deduct those contributions on your tax returns. This means you write it off at the end of the year, reducing your taxable income, just like you would for a traditional IRA contribution. It's a direct reduction to your adjusted gross income, which can have ripple effects on other tax credits and deductions you might be eligible for. So the first advantage is clear. You save money on taxes right now just for putting money into this account. This is a huge, immediate win, a tangible benefit you see on your pay stub or at tax time. Don't underestimate the power of this immediate tax reduction. It's money back in your pocket that you can then use to, well, probably save more because you're financially savvy, right? Advantage number two, tax-free growth. This is where the HSA starts to pull away from almost every other savings vehicle out there. Not only do you get a tax deduction on the way in, but the money in your HSA grows completely tax-free. Let that sink in. Most HSAs allow you to invest the funds once they reach a certain threshold, often a few hundred or $1,000. You can invest in mutual funds, ETFs, stocks, just like you would in a 401k or an IRA. And here's the kicker. All the dividends, all the capital gains, all the interest earned on those investments, completely tax-free. You don't pay taxes on the growth year after year. Compare this to a regular taxable brokerage account, where you'd be paying capital gains taxes every time you sell an investment for a profit, or income tax on dividends. You're losing a chunk of your earnings to Uncle Sam year after year. Even with a traditional IRA or 401k, while the growth is tax-deferred, you eventually pay taxes when you withdraw the money in retirement. With an HSA, assuming you use it for qualified medical expenses, that growth is never taxed. Imagine you're 25, young, healthy, you max out your HSA contributions every year, and you invest that money wisely. Over 40 years, with an average annual return of 7%, you could easily accumulate hundreds of thousands of dollars, potentially even $1 million, all growing completely tax-free. Think about the power of compound interest when it's not being eroded by annual taxes. This is a massive long-term wealth-building engine. This isn't just about saving for a doctor's visit next year. This is about building a substantial, tax-sheltered nest egg that can be used for healthcare expenses throughout your entire life, including in retirement. This is the part that many people miss. They treat their HSA like a checking account, letting the money sit in cash, earning next to nothing. Stop doing that. You are sabotaging your own financial future if you are not investing your HSA funds. It's like having a Ferrari and only driving it in first gear.
Unlock the full potential.
Advantage number 3. Tax-free withdrawals for qualified medical expenses. This is the final, glorious piece of the triple tax advantage puzzle, and it's what truly sets the HSA apart. When you withdraw money from your HSA to pay for qualified medical expenses, those withdrawals are completely tax-free. This is not tax-deferred. This is tax-free. You got a tax deduction on the money going in, it grew tax-free, and now you're taking it out tax-free. It's like a Roth IRA on steroids, but even better, because you get the deduction on the front end too. What counts as a qualified medical expense? This is a broad category, encompassing everything from doctor's visits, prescriptions, dental care, vision care, mental health services, chiropractic care, even things like crutches, contact lenses, and certain over-the-counter medications with a doctor's prescription. You can find comprehensive lists from the IRS publication 502 as your friend here. The key is that it must be for legitimate medical care. Now, this is crucial. You must keep good records of your medical expenses. Save those receipts, scan them, upload them to a cloud service, whatever it takes. Why? Because if you're ever audited, you'll need to prove that your withdrawals were for qualified medical expenses. If you withdraw money for non-qualified expenses before age 65, that money will be subject to ordinary income tax and a hefty 20% penalty. We want to avoid that nightmare scenario at all costs. So, this is where the HSA shines compared to a flexible spending account, FSA, which is often confused with an HSA. An FSA is a use-it-or-lose-it account, meaning if you don't spend the money by the end of the plan year, you forfeit it. An HSA, however, is your money for life. It rolls over year after year, indefinitely. You never lose it. This makes it an incredibly powerful tool for long-term health savings. So you've got tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. This is the triple tax advantage. It's powerful. It's unique. It's something you absolutely need to leverage. But wait, there's more. I hinted at a fourth advantage, a secret superpower that makes the HSA not just a health savings account, but one of the most powerful retirement accounts available. This is the game changer, the part that truly elevates the HSA to legendary status. After you turn age 65, the rules change significantly. Once you hit 65, you can withdraw money from your HSA for any reason, not just qualified medical expenses, without penalty. The only catch is that if you use it for non-medical expenses, those withdrawals will be subject to ordinary income tax, just like withdrawals from a traditional IRA or 401k. Think about that. You get the upfront tax deduction, tax-free growth, and then in retirement, it functions just like a traditional retirement account. But here's the crucial difference. If you do use it for qualified medical expenses after 65, it's still completely tax-free. So it gives you ultimate flexibility in retirement. You have a pool of money that you can use tax-free for all those inevitable healthcare costs in retirement. Medicare premiums, deductibles, co-pays, long-term care insurance premiums. Or, if you're lucky enough to be incredibly healthy and have minimal medical costs, you can use it as a supplemental retirement income stream, just paying income tax. This makes it an incredibly versatile, powerful tool for retirement planning. It's a healthcare expense account that can moonlight as a traditional retirement account, offering unparalleled flexibility and tax benefits. This isn't just about saving for a broken arm. This is about securing your financial peace of mind decades down the road. Now let's talk about some advanced strategies, some HSA tax hacks that truly unlock its full potential. Because simply knowing the triple advantage isn't enough. You need to know how to use it. The pay me back strategy, the receipt hoarding hack. This is perhaps the most powerful and underutilized HSA strategy. Here's how it works. Instead of paying for your qualified medical expenses directly from your HSA, you pay for them out of pocket with your regular checking account or credit card. But here's the critical part. You meticulously save every single receipt for those qualified medical expenses. You digitize them, you back them up, you keep them safe. Why would you do this? Because the IRS allows you to reimburse yourself from your HSA for past qualified medical expenses at any point in the future, as long as those expenses were incurred after your HSA was established. Let me repeat that. You can pay for a doctor's visit today, save the receipt, let your HSA money continue to grow tax-free for 10, 20, or even 30 years, and then when you're ready, you can reimburse yourself for that original expense, tax-free. Imagine you're 30, healthy, and you have $500 in medical expenses this year. You pay them out of pocket. You save the receipts. You let your $500 stay invested in your HSA. Fast forward to age 60. That original $500, having grown tax-free for 30 years at, say, 7% annually, is now worth over $3,800. You can now withdraw $500, the original amount of the expense, completely tax-free, and you still have over $3,300 left in your account that has also grown tax-free. You've essentially gotten a loan from your future self, and that loan was free. This strategy allows your HSA to grow for as long as possible, maximizing the power of tax-free compounding. This is how you turn a simple health savings account into a multi-generational wealth-building machine. This is not for the faint of heart or the disorganized. You must keep those receipts. This is your proof. Without them, you risk penalties. But if you can master this, you are truly playing 4D chess with your finances. Maximizing contributions, even if you're healthy. Don't fall into the trap of thinking, I'm healthy, I don't need to put much in my HSA. That's precisely the wrong way to think about it. If you're healthy, you have the greatest opportunity to let that money grow untouched for decades, leveraging the pay me back strategy. Maximize your contributions every single year. For 2024, that's $4,150 for individuals and $8,300 for families. If you're 55 or older, you can contribute an additional $1,000 as a catch-up contribution. This is free money, tax advantage money, that you are leaving on the table if you don't contribute the maximum. Think of it as your emergency medical fund, your long-term care fund, and your supplemental retirement fund, all rolled into one. Common mistakes to avoid. I want to save you from this nightmare. 1. Not investing your HSA funds. This is the biggest sin. If your money is just sitting in cash, you are missing out on the tax-free growth that makes the HSA so powerful. Check with your HSA provider. Most have investment options. If yours doesn't, consider transferring your funds to a different HSA custodian that does. 2. Not understanding HDHP eligibility. You can only contribute to an HSA if you are covered by an HDHP and have no other disqualifying health coverage like Medicare or a spouse's non-HDHP plan that covers you. Make sure you understand the rules. If you contribute when you're not eligible, you'll face penalties. 3. Using funds for non-qualified expenses before 65. As I mentioned, this leads to income tax plus a 20% penalty. Don't do it unless it's an absolute emergency and you understand the consequences. 4. Not keeping receipts. I cannot stress this enough for the pay me back strategy. Your future self will thank you for being meticulous. 5. Confusing it with an FSA. Remember, HSA money is yours forever. FSA money is use it or lose it. They're completely different animals. Let me talk to some specific demographics directly, because the HSA is relevant to everyone. To the young, healthy, individual 20s, 30s. I know you feel invincible. You might think healthcare costs are a distant concern, or that an HDHP is too risky. But this is precisely your moment to shine with an HSA. You have the longest runway for that tax-free growth. Imagine starting now, maxing out your contributions for even just 10 years, and then letting that money compound for another 30 or 40 years. You could easily have hundreds of thousands of dollars available for future medical expenses or retirement. Don't let the fear of a high deductible stop you. Often, the premiums for HDHPs are lower, and the money you save on premiums can go directly into your HSA, offsetting some of that deductible risk. Plus, many HDHPs offer first-dollar coverage for preventative care, meaning your annual checkups are still free. This is your secret weapon for building wealth early, avoiding taxes, and securing your future health. Don't be complacent. Start now. To the parent or family provider 30s, 50s. You're juggling a million things, and healthcare costs are a constant worry. Kids get sick, accidents happen, braces, glasses, it all adds up. An HSA, especially with family coverage, allows you to save a significant amount, $8,300 for 2024, on a tax-free basis for all those inevitable family medical expenses. And don't forget the pay me back strategy. Pay for those kids' dental cleanings and save the receipts. Let that money grow, so when the unexpected major medical event happens, or when you're older and facing your own health challenges, you have a massive tax-free reservoir of funds to tap into. This isn't just about saving money. It's about reducing financial stress when your family needs care the most. It's about having peace of mind. To the freelancer, entrepreneur, or self-employed individual, you're often forgotten by traditional employer-sponsored benefits, but the HSA is tailor-made for you. You can purchase an HDHP on the individual marketplace and then open an HSA with a custodian of your choice. You get to deduct those contributions directly from your income, significantly reducing your tax burden as a self-employed individual. This is a huge win. You have complete control over your investments and your funds. This is a powerful tool to manage your self-employed healthcare costs and build personal wealth simultaneously. Don't let being self-employed be an excuse to miss out on these incredible benefits. To the pre-retiree or retiree 55 plus, it's not too late. If you're 55 or older, you can take advantage of catch-up contributions, adding an extra $1,000 per year to your HSA. Healthcare costs in retirement are a massive concern for almost everyone. Medicare premiums, deductibles, copays, prescription costs, potential long-term care needs, these can quickly decimate your retirement savings. An HSA is the perfect vehicle to save specifically for these expenses, and because withdrawals for qualified medical expenses are tax-free, it's an incredibly efficient way to fund your healthcare in your golden years. Remember, after 65, you can even use it for non-medical expenses without penalty, treating it like a traditional IRA. This is your last chance to supercharge your tax-advantaged savings, specifically for the biggest expense most people face in retirement, healthcare. Don't miss this opportunity to fortify your financial security. So what are your actionable steps right now? 1. Check your health insurance. Are you currently on an HDHP? If not, investigate if your employer offers one or if you can find one on the individual marketplace that makes sense for you and your family. 2. Open an HSA. If you're eligible, open an HSA immediately. Your employer might provide one, or you can choose an independent custodian. Look for one that offers low fees and good investment options. 3. Start contributing. Even if it's a small amount to start, begin contributing. Aim to maximize your contributions if possible. Set up automatic payroll deductions if available. 4. Invest your funds. Once you have a comfortable cash buffer, E.G, enough to cover your deductible, start investing the rest of your HSA funds. Don't let them sit in cash. 5. Keep meticulous records. Save every single receipt for qualified medical expenses, regardless of whether you pay for them out of pocket or from your HSA directly. This is your golden ticket for the pay me back strategy. 6. Educate yourself. Read IRS Publication 502, talk to a qualified financial advisor, understand the rules inside and out. Knowledge is power, especially when it comes to taxes. This isn't just about saving a few bucks here and there. This is about taking control of your financial destiny, mitigating future healthcare risks, and building truly tax-advantaged wealth that few other accounts can offer. The HSA is a gift, a powerful tool designed to empower you. Don't leave this money on the table. Don't let misconceptions or inertia keep you from harnessing its incredible power. This is urgent. This is important. This is one of the most significant financial advantages available to you today. Go forth, investigate, and unlock the triple tax advantage of the HSA. Your future self will thank you for it, profoundly.